Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Cliff Corso, president and CIO of Advisors Asset Management, to discuss how investors should be positioned in equities, fixed income, credit, and income-oriented alternatives. It's great to see you as always, Cliff. Welcome back to Trade Talks.
Thanks for having me, Jill.
You got it. And before we get into asset allocation, let's get your thoughts on the macro for a moment here. What are you continuing to focus on?
Well, we're really focused on inflation, as is many people in the market. And today's jobs report just illustrates the problem, I think, in front of the Fed. A very hot jobs report. Some of the numbers softened a little bit, but still historic, decade-long low rates of unemployment. So that just kind of keeps pressure on inflation and keeps the Fed in play, which is obviously a challenge for the market as well.
Right. Well, I mean, and certainly it does impact the housing market and mortgage rates. It seems as if the supply and demand situation is just stuck.
Yeah, that's a really good point, Jill, because obviously the Fed is trying to destroy demand by raising rates. But at the same time, they also have destroyed supply. If you think about mortgage rates, there's a whole huge cohort of people in homes with 3% mortgage rates. And normally they might, if they want to move, look at other houses, they might do that if the mortgage rate were the same. But with the mortgage rate double 3%, a lot of people are stuck in their home financially. And that's destroyed a lot of, actually the largest part of home supply is used homes, not new homes. So that's created a little bit of a problem for the Fed, and that maybe housing and shelter costs won't come down as much as they would have otherwise expected.
So it almost sounds like we're in a stagflation scenario. Some parts of the market are really good. Some are really bad. I mean, employment, it's just not budging. The housing market, to your point, it's not moving. It sounds like we're just stuck.
Yeah, it's a good way to put it as well. I think the way I kind of think about where the economy is, and there's a big debate: are we, going to have a recession? Are we in a recession? We're not going to have a recession. Our view is we think we're going to have a recession. But if you step back from that and you think about what we would call a K-shaped evolution of the economy, the top part of the K would be sectors and industries with secular tailwinds that are still going to be winners. An example, I think, would be defense. We know what's going on in the global world. That would be a sector that would, regardless of a recession, still be on the upper end of that. And then clearly very rate sensitive sectors, consumer discretionary, would be on the bottom side of that K. So, we want to spot the ones on the upper part, obviously, and avoid the ones or underweight sectors on the lower part of that K.
Let's talk about asset allocation with this backdrop. How are you approaching fixed income?
Well, the good news, I think, is a year later, the Fed has finally put income back in fixed income. And so within fixed income, rates obviously have come up dramatically, but we have an inverted yield curve, meaning shorter maturities are yielding more than longer maturities, quite unusual. It portends a slowing economy, in essence. We think that that front part of the yield curve, shorter maturities in that 5% range, are the most attractive part of the curve. And without adding a lot of interest rate risk to it, why wouldn't we want to go further out? Because our view is that we're in a sticky inflation environment. We're not quite sure that long rates, in essence, will not move around a lot and be quite volatile. So we would stick with that shorter maturity at the current time.
And when you take a look at equities, you're also looking for income producing opportunities.
That's exactly right, because we think we're in an era of elevated volatility around markets and the economy, and we're looking for predictable sources of return. Within equities, income has been a very durable and predictable source of return, particularly quality companies that pay steady dividends and high dividends. So we're very focused on those sectors within the equity markets.
And the same with credit as well. You're looking for income opportunities on the higher end of the spectrum.
That's correct. I would say in the lower quality part of the credit markets, we are very optimistic and like to overweight private credit. Now, you might question me and say, well, you just said that a recession is coming. Why would you want to be in private credit, which tends to be a little bit lower rated, lower down the scale of quality? It's because the regional banks have pulled back so far, that the spreads or the yield opportunities offered by firms that can fill in those gaps, private lenders, are getting tremendous yields now that they weren't getting 6, 9, 12 months ago, and better covenants. They're able to drive better structures and safety around those transactions. So we do like the private credit arena very much in the lower rated sector of the market.
And finally, Cliff, if we look ex-US, where are you getting some geographical diversity?
We think diversification is a very key principle here. Again, we think a challenged market is ahead of us in the US. We like the developed markets in Europe. The valuations are a lot closer to below historic norms versus our markets. And you can see there inflation is potentially beginning to slow down a little bit quicker than in the US, meaning they might be done tightening quicker than the US. But the valuations are quite attractive, and there are many, many great companies across developed Europe as well as EM, where China's slowed down a little bit, but that's probably going to create just more fiscal and monetary easing within that economy, and obviously a very strong second largest economy in the world. So those are the kind of opportunities we think make some sense today.
All right, Cliff, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.